Right, let's get started. So as I was saying, the presentation this evening is all about accruals and prepayments. And from obviously the chat panel, you know, a lot of you are going to be dealing with or will be examining on accruals and prepayments within your examination. So for example, on the ACCA, you're certainly going to see it on F3 and F7, and you know it'll come through on like your P2 papers. In terms of your CIMA papers, definitely on your certificate, so that's your C5, and definitely you'll see it on your F1 exam papers. Okay, so let's get started. So first of all then, let me just this is what I'm going to be covering this evening. So first of all, I want to talk to you about what the accruals concept is. This is fundamental. And then we're going to be looking at expenditure and income. And in both occasions, we're going to be looking at accrued and prepaid expenditure, and also accrued and prepaid income. So I'm going to be explaining what they are, and then giving you an example for you to obviously work through. Okay, so let's get started with the accruals concept, and this is my definition of the accruals concept. And effectively all it is matching income and expenditure in the period it happens, and not when cash exchanges hands. And you know, all I mean here is that, you know, when we produce an income statement, we need to ensure that we've accounted for all the revenue and all the expenditure in that relevant period, regardless of whether the cash has been received or has been paid. So if we were to think about this in our working environment, you know, if you're doing your month end or your year end, when we're having to deal with accruals and prepayments, it's normally because we're not received the invoice. So if we receive the invoice and we obviously process the invoice, it then gets accounted for within our financial systems. However, in the exam, or for you in the exams, what it is because something hasn't either been paid, it has been paid, but it's depending on the timeline of when these payments or the receipts have obviously been received. Okay, so just once again, this is a fundamental concept and we need to get our heads around it. So we just got to ensure that we match our income and expenditure in the period it happens. You know, so if we, if we earn income and we obviously pay, money, expenditure, then it needs to be accounted for in the period it happens. Okay, doesn't matter when the cash exchanges hands. We need to account for that income and expenditure in the period that it actually happens. And so what I want us to start first of all then is to actually look at accrued expenditure. So as we can see on my slide here, what I'm saying here is that, you know, accrued expenditure basically is when an expense of the business has not been accounted for at the year end. So when I talk about expense, what I mean here is we're looking at your day-to-day running costs. So can anybody give me an example of a day-to-day running cost? Fantastic. Anybody else got any in your ideas? Oh, fantastic. Any other examples? So our heads around is what do we mean by an expense? We're saying expense is a day-to-day running cost. Okay, in admin costs, absolutely. Else got any other ideas? There's lots of ideas for, you know, you've got your light, you've got your heat expenditure, you've obviously got your insurance, you know, things like stationaries and your sundry expenses. They're all ideas of an expense. So actually, you know, that's an expense. The question is, we might have used the expense in the period, we've just not received the invoice, or we've just not accounted for it. In terms of accounted for them, what I mean by here is, and you know, as I said earlier when I was explaining the accruals concept, is, you know, it means that we've not received the invoice, and because we've not received the invoice, we've not processed that invoice, and therefore it's not made its way onto our accounting system. As I said, for you lot in your exams, it just means that we've not paid that expense, okay, and therefore we need to account for it. So what I say here is therefore we need to record the expense. As you can see, I've underlined the record, and all I'm saying here in terms of recording is that we need to get that expenditure into the nominal ledger. So we have to do a journal entry. When we think about this logically, we need to increase the expenditure, okay? We need to increase the amount of money that we've spent on that particular expense, and therefore we need to debit the income statement. So what we are doing is that obviously, as we all know with the old double entries, there's always two sides of the story, and therefore we need to put a credit somewhere, and what we do is that we set up an accrual, okay? And the accrual is going to go to the financial position. So in terms of where the accrual lies within the financial position, it actually is a current liability. Can you explain to me why you think it's a current liability in the financial position? Paul is saying because it's owed. Catherine saying it's an expense was carried in the year, even if it's not expense. Absolutely, you've actually both hit it on the nail here. Is we know we've not paid it in this financial year, and yes, we know we're going to have to pay for it in the next financial year. We're accounting for it now because we have to, because that's the accruals concept. So we're going to set it up as a current liability because what we're saying is because we know we're going to have to pay it in the next financial year. So fantastic, well done Paula and Catherine. Okay then, so what I'm saying here is, once we've recognised we've not accounted for an expense, we need to get it into our nominal ledgers as soon as possible, and therefore we need to debit the particular expense account. So it might be your light or heat, or it might be your waste. It depends, okay? It depends on what the expense is, but we will always credit the accruals in the financial position. Okay, another question that I want you to answer, and this is, okay, by doing this journal entry, what is the effect on the profit? Okay, as you can see, I've just gone on to another screen. So what I want to know here is, what is the effect on the profit by us doing a journal entry? Hamid and Catherine, we're going to get lower profits. Because if we think about it, revenue is going to remain the same, but we're effectively increasing our expenses, which is reducing our profits. So well done, fantastic. Okay, so we need to think about that because a lot of questions I've seen both on the CIMA and on the ACCA paper, and also the AAT paper, it does actually ask you, by doing this journal entry, what's going on with the old profit? And you're correct, it will reduce the profit by actually posting this journal entry through. Then, so what I want us to do is I want us to have a look at an example, and I actually want you to do some work on this masterclass. So what I'm just going to do, I'm just going to go back to my presentation, and just changing the slide. We've got an example here. So, we'll just talk through it, and I'm going to give you a couple of minutes for you to see what you think the answers are going to be. So, EC Limited gas charges normally amount to 24,000 per annum. So the PA stands for per annum. And in the year to the 31st December 2012, 21,500 has been paid. The gas for the final quarter is paid in January 2013. What I want to do, so obviously I'll give you a couple of minutes, you might need to go and find your calculator or whatever, because you might not be expected to have to do some work. What I want to know is, what is the year-end accrual, and what are the relevant journal entries? Okay. panel, and then obviously I can review whether you're correct or not. Now, if you're, obviously, I do appreciate that this is like similar to being a classroom, and sometimes you don't actually want to put your hand up and say this is the answer, but Kat's already done that, then you can do it to me privately through the chat panel. Okay, so let's give you a couple of moments. I think Catherine, well, Paula says she agrees with Kat, fantastic. Hamid has gone a little bit quiet, or maybe I can't see his answer. But effectively, yeah, you're both correct. Okay, Hamid. So all we're saying here is, and this is quite a relatively straightforward example, but what we're saying here is we know exactly what we need to spend. So what I'm saying that, we're saying that, that we're going to put through to the income statement is 24,000. Sat in, and I'll do a little T count here, under our expenses, so under our gas charges, we have the debit side that we've got paid to the bank, or paid from the bank should I say, we've got 21,500. What I know is what I need to transfer through to the income statement is $24,000. So, as the journal entry says, is that once we know we need to account for something, then we do need to obviously debit the income statement. And the difference is, and you're very well correct, is the 2,500. So what I do here is debit the gas account by 2,500. And yeah, we've got to set up a liability because we're saying we need to pay this in the next financial year. So yeah, I'm going to credit the accruals 500. So fantastic. So what I'm going to do is put my gas account, and all I'm going to do is call it an accrual, because obviously we have to put the other side of the journal entry into our T account, and we're going to have 2,500. And effectively the journal entry. So what happens is, comes to the end of the financial period, we get the 24,000 through to the TB, and then that finally goes through to the income statement. With what I've done, I'm just trying to keep it relatively straightforward. Has anybody got any questions you want to ask me regarding this example, or regarding anything about the example I've just done, or anything related to it? Okay, fantastic. So that's kind of looking at accrued expenditure. What I want to do now is have a look at the prepaid expenditure, which is kind of the opposite to accrued expenditure. So let me just go back to my PowerPoint slides. What we do now is prepaid expenditure. So as I said, this is the complete opposite to obviously what we've been looking at in terms of accrued expenditure. Effectively, the expense arrives, it rises when an expense of the business has been paid in advance. Come on guys, why would an organisation want to pay something in advance? So Paul is saying might be given a discount. Absolutely. You know, if we can get some money off by paying up front, then absolutely fantastic. As Rita, Kat saying because we have to. You're absolutely right. And even Kat's given us an example, which is rent. Yeah, a lot of times when we're paying rent, we have to pay up front, whether it's, you know, for a full 12 months or it's for, you know, a quarter. And obviously that's rent in advance that we're having to pay over might not coincide with our financial year end, and therefore we'll have paid for some of the months in the next financial year. Okay, so as I was saying, yeah, it's because we've paid it in advance, and the payment that we've paid in advance, and I'm not saying all of that payment, but so many of those months will relate to the next financial year. And this is when we come back to the accrual concept, where we must match income and expense in the period it happens and not when cash exchanges hands. So all that's happened here is that the cash has exchanged hands. But some of that money that we've paid today actually relates to the next financial year. And as I'm saying on my, you know, on my, is that we must remove this expenditure from the nominal ledger, okay? Because if we don't do it, then we're going to overstate the expense, which effectively is reducing the profit. So how on earth do we remove it? So once again, we're going to go back to the old journal entries, but effectively we need to reduce the expense, and the way to reduce the expense is actually to credit the expense account. And by crediting the expense account, as I said, there's always two sides to a story when we're dealing with double entry, and therefore the other side is that we're going to set up a prepayment account, okay, which is sat in the financial position. So a prepayment will lie as a current asset in the financial statement, but guys, why is it a current asset? What explanation can we put to it's a current asset? Why is it? Rita, because it is like money, absolutely. Cat saying, because we will receive the benefits in the future, fantastic idea. And Catherine also the same, because the actual service hasn't been received. If the company went bust, we could, and we'll put up, we could potentially claim it back. I really, really like those ideas, and they're all correct. Okay then, so what I'm going to do is I'm just going to go back to my journal sheet, and I just want to explain this in a little bit more detail. There are different ways in which we can explain this, and I always say use the one that, you know, helps you the most. So, in text, it's because it's like money, which is what Rita's saying. I'm going to give you as an example. Let's say we have prepaid. Oops, let me just share the screen again. Let's say prepaid. What's a classic prepayment then? Let's use rent. What's another classic prepayment? Oh, yeah, and Gita, fantastic. We've got insurance maintenance. To be I did have actually insurance in my mind, and if I could show you the piece of paper I've got on there, I've actually written insurance on. So we've prepaid insurance, absolutely. And let's say we prepaid insurance by, let's say, and I'm talking dollars because everything's in dollars in your exams, let's say by 5,000. Oh, even Gita says it's subscription. Fantastic, because we're all thinking about our ACCA or CIMA or ACA or our AAT subscriptions. Absolutely. So let's say we've prepaid our insurance in advance, okay? So what's actually happened? What's the double entry for us paying this insurance? We've gone, oh, doing it. Okay, so what's double entry? Again, yes, I can. What is the double entry for insurance? So what am I debiting and what am I crediting? Doesn't matter about money. And I think Karen was the first one to come up, which is correct. is that, yep, we're going to be debiting the insurance expense and crediting the bank. Absolutely. So, saying is we pay insurance, okay, and we're going to the expense, so debit the insurance expense, credit the bank. So what's happened is we've reduced the bank, which is reducing the current asset sat in the financial position. Is everybody happy with what I'm saying? Fantastic. Friends on board? All I do is we paid insurance, debited the insurance, income statement, we've credited the bank. So by crediting the bank for this insurance, we've reduced the bank and therefore reducing the current asset. So when we come to the year end, we realise that we've actually prepaid 5,000 of that insurance, which actually relates to the next financial year. So yeah, we are going to create a journal entry. So effectively, we're going to debit the prepayment. Oh, it has already come up on this one. We are actually going to be crediting the expense. Okay. We're going to obviously reduce the expense, which is effectively what it doing to the profit by us crediting the expense account. Fantastic, Catherine. Yep, we will be increasing the profit. But what we are doing here is we are debiting the prepayments. If we think about the current assets that are sat in the financial position, so this is me doing a bit of an extract. You got your inventories, your trade receivables, this basic one. Then we've got prepayments. We've got the bank. So if we think about this logically, what's happened here is in the financial year we've paid out the insurance, of which £5,000 relates to the next financial year. So all we've done is we've reduced the bank by $5,000. Putting that journal entry through and debiting the prepayment, we've actually increased the prepayment account by $5,000. What we're doing here is we're just contouring what's happening with the sense, and can you understand this explanation? Okay. So one way to look at, the reason why a prepayment is obviously a current asset. Yeah, so we've got 5,000 in pots and and it's just effectively contouring out that 5,000 that's been paid. We can hit on the head, and I can give you another explanation of why the prepayment, is a current asset. And I can't remember which one of you did it, but you say, well, actually, if that company went bust or went under, effectively we would get that money back. Well, let's go with the same example we've got up here. Is that we've got an insurance. We paid 5,000. Let's say we want to cancel that insurance policy. Here, so we want to cancel that insurance policy at the end of the financial year. And what we're saying here that if we were to cancel it, we in theory should get that money back. Oops. If we were to cancel, and that's the in theory bit, because you know what people are like when we have to pay things back. We don't like to. So in theory, we should receive the money. What we're doing is once again saying that this £5,000 is effectively roundabout way, cash. And what we know is cash is a current asset. So there's the two ways in which you can think about a prepayment. One is it's just conjuring out the payment for that financial year, and the other one is, well, actually, if I was going to cancel that prepayment, I should receive the money back. So there's two ways to think about it, and I always say use the one that makes more sense to you, to yourself. Everybody thinks differently. Okay then, so is everybody happy with that definition of why prepayment is a current asset? What do we do with the credit? Okay, I'll explain here. So I'm going to draw another T account, okay, and what we've got here is the expense. And let's, as we're on the theme with insurance, let's say we paid, okay, and let's say, actually, the year charge was 15,000, and we've got that prepayment of 5,000. So effectively, that 20,000 includes the 5,000 prepayment. What we is that we need to transfer 50,000 through to the income statement. What we need to do is we need to effectively reduce the account for the prepayment. So now we're going to put a credit for our prepayment. So all I'm going to do is put prepayment . Okay, so are you happy with that, Rita? All I'm going to do is debit the expense, debit the prepayment, which is an asset in the financial position, and we're crediting the expense because we need to reduce that expense because it doesn't relate to this financial year, and once again we're falling back onto the accruals concept. About if we were to cancel the insurance, it's as if to say if we were to. We haven't. It's kind of an explanation of effectively, if we were to cancel it, we would get the cash. If we get it, cancel the insurance, we would be crediting the expense account and therefore debiting the bank because we will get the money back. So that's enough of me chatting and explaining about prepaid expenses. What I now is I've got an example, once again, a relatively straightforward one, because I appreciate that we're trying to get our head on the old accruals and prepayments. So if I just go back to my PowerPoint presentation, I've got a question that I've devised. Okay, oops. Then, the question is, and once again, I'll just give you a couple of minutes just to work out, because you're next going to get your calculator. But ABC Limited has just started in business and has recently agreed to pay $1,200 per month and paid 18 months in advance. So year-end adjustment is required, and what are the journal entries? I'll just give you a couple of minutes. Once again, if you're feeling confident, okay, put it on the chat panel to everybody, but if not, do it to me privately, okay, because I know sometimes we don't like to. We've got tons of people who've come back to me privately, so that's fantastic. The question I'm not going to answer. Okay, because I will be explaining this in more detail. Paul is saying we need to do prepayment 7,200 and credit the rent expenses. I'm not saying whether it's right or wrong. I'm just waiting for a few more people. Yeah, so we've had to use our calculator, but I've had my calculator on this one. Okay, we'll be going through this in a lot of detail and explain this. Giving me the journal entry, fantastic. You're doing really, really well. I'm really impressed. Okay then, so let's have a look then. I've just gone back onto my my writing screen. So what I'm saying here, and as the question says, is, you know, ABC's just started in business and has recently agreed to pay rent of $1,200 each month. Okay, a month, and has paid months in a, what we're going to do here, how much we'll do is pay to 18 times 1,200, and my calculations is 21,600. Okay. Remember, the rules concept is that we need to match income and expenditure, you know, in the period happens, you know, for that financial year. So as we're all aware, financial years are always 12 months. So let's just draw a T account, and obviously rent. So what we've got here then, let's say, you know, we've got the 1st of January 2012, you know, we've paid up front 18 months worth of rent is 21,600. Okay. Now, obviously, what we're concerned is, you know, what rent should we include in our income statement for the relevant financial year. So we've paid 18 months, and effectively we only want to account for 12 months in our financial year. So 12 times 1,200 gives me a of 14,400. So that's effectively what we need to be showing in our income statement for the financial year. So there's loads of ways of how to work your prepayment, but how I always think about it is, well, that's what we need to be showing in our financial year. So what we're saying here is that we need to transfer to the income statement 14,400. That's effectively the balancing figure within our rent T account. What we do know is that we have prepaid okay. So we've paid 18 months, we're only going to be counting for 12 months because I'm using that accruals concept, and therefore we've actually prepaid 6 months, the 6 months payments in advance. So all I'm going to do is just times that by 1,200, and that gives me a figure of 7,200. So well done to everybody who correctly calculated the 7,200. Therefore, is that to get a statement charge of 14,400, and I've currently got a bank charge of 21,600, I have to credit my rent account, and therefore all I'm going to do is post credit of 7,200. Okay, so it all balances off, and my T account has been shut off for the financial year. In the prepayment account, so just excuse me, I'm just going to draw another T account. We've got a prepayment in the financial position as a current asset, and we say it's going to be the 31st of December 2012. Have a prepayment out there for 7,200. Okay, everybody happy with what I've just explained? So you're fantastic. The vast majority got it right. We do need to debit the prepayment for the 7,200, and therefore we need to credit the expense account by the 7,200. Fantastic, well done. Okay, everybody else Happy? So we're on with the concept of what an accrual is. So an accrual is that we've used the expense but not paid for it, where a prepayment means we've paid for it but actually not used it. It relates to the next financial year. Because what I'm going to talk about now is kind of, we just need to think a little bit outside the box in terms of, well, actually, what's going on within the income statement and the financial position, because what I'm going to talk about now is what tends to be appearing in your exams. So just bear with me a second while I just go back to my PowerPoint slide. Here then is the financial statement, and within the income statement, what we're saying here is, and I've been talking about it when I've been talking about those two examples, is that the income and expenditure is transferred to the income statement at the year end. So by that, and I'm just going to go back to my journals. So this one here, what we're saying here is that once the year ends come and we know exactly what the charge is through to, what we need to put through to the income statement, we literally transfer that figure. So that 14,400 simply gets transferred to the income statement, which means in the new financial year, so on the 1st of January 2012, you're starting with 0. Because the format of the income statement is that I'm only interested in the income and expenditure for that relevant year. So when we move on to, oops, sorry, I put the wrong date, the 1st of January 2013. So when we move to the next financial year, I ain't bothered about what expenses I had in the previous year. I only want to focus on what we've spent or received in the current year. Okay, that's a really, really important concept. So all I'm saying here is that your income and your expenses account what belong in the income statement. The next financial year, you'll start with 0. Okay. The applies with the financial position. Okay. So, with the financial position, what I'm saying here is that the balances in the financial position at the year end becomes opening balances in the new accounting period. Those accruals and prepayments that we posted in 2012 in the financial position as an accrual or as a prepayment doesn't disappear as it does within the income statement. So what we really have to do is that we could leave them there in the financial position, but we wouldn't be showing our accounts in a true and fair view. But at the beginning of the new financial year, we effectively need to reverse them out of the financial position. So anybody within the workplace, have you ever heard of the term reversing journals? Absolutely, Catherine's saying yep. This is effectively what a reversing journal is. We post it one month or one financial year, and then it gets posted out in the next financial year. So all we're doing is just effectively reversing that journal entry. Is everybody happy with what I said? Because this is the concept that we really need to get our heads around, which will help you in your exams when you're facing a question on accruals and prepayments. So everybody's gone quiet. Okay, example then. Not that I've got an example at the moment. I want to go back to, oops. Okay, so let's go back. So let's take the example I've got here. So we've got the rent last year. We prepaid for 18 months, which is the 7,200. Okay, let's say we're in the new financial year. So we're in 2013. Wow, we're going past these financial years quickly. So what we need to do now is effectively we need to get rid of this rent in the prepayment account, because we need to account for it within the rent account in the income statement. And if we don't reverse this out, then we're going to be obviously understating the rent for the financial year. So what I'm going to effectively do is reverse that journal. So on the 1st of January 2013, all I'm doing to the rent account of 7,200, which means, let me just do a new rent account. That's 1st of January 2013. My prepayment of 7,200, and all that means is, okay, is that we're now accounting for this in the correct financial period. Okay, that's on it. And so yeah, so these we do a bit about it. I'm looking at it as a 12-month period. Obviously, in organisations, you would be looking at on a monthly basis. So yeah, I can see where you're coming from, but you're not in the exam, you'll be dealing with it on a 12-month period, so it'd be like a yearly period, okay? But yeah, in your workplaces, you will be doing this on a monthly basis. Okay, so is everybody happy with what I'm doing? No, don't apologise. What you're saying is correct, and it's good that you're thinking and you're probably relating it to the workplace. That's fantastic. Okay, so let's have a look then at the accrual example, what we did up here. Did I do accrual account? I didn't, but we had the accrual of 2,500. So exactly the same principle here. So we've got an accrual. We've obviously got the bank figure, not bank, sorry, it was gas, 2,500. We need to reverse this out, okay? And the reason we need to reverse this out is that, you know, we will eventually pay the gas bill because we'll receive the invoice. And if we don't do anything with this accrual, it means we're going to overstate the gas in the next financial year. So if I just do another T account, I'm just going to do it, this is the correct page. So if I just create another T account, which is my gas, okay, then on the 31st of January, we receive a gas bill and we pay it, and let's say we pay, I don't know, £7,000. With £7,000 is actually relating to the 2,500, which relates to the previous year. So we need to reduce that gas charge to take into account actually £2,500 of it relates to the previous year. And this is what we do by reversing out this journal entry. So what I'm going to do here is I'm going to say it's going to go to the gas account, that's where the other side of the journal entry is, the 2,500, which effectively means that we have an accrual brought down of 2,500. So when we were to, if we were to balance this off, then it's quite clear to see that we would have a balance carried down of 4,500, and that basically means that's the gas charge for this financial year so far to date. So everybody happy with that explanation? Because I just think it just helps us focus and see exactly why we're doing it. So we paid the bill for £7,000, £2,500 of that related to the last financial year. Well, we need to do something, because if we don't, we're going to overstate the gas for this financial year, and we're certainly not going to be showing our accounts in a true and fair view. So by reversing that accrual back into that gas account, it's reducing that gas charge, which is therefore showing the, you know, the gas charge at its correct amount. Okay, so is everybody happy with that explanation? That's the difficult bit, okay? But I think when we break it down, it makes a little bit more sense. Okay, so a few people saying they've understood that, which is fantastic. Don't be put off at all. What I've done is I've drawn a lovely T account of basically how your expenditure account would look like, taking into account your prepayments and your accruals. Your prepayments and your accruals brought down are effectively the ones that you've reversed out from the previous year. Okay, I think this is essential, so you know, at least copy this down. Okay, because what you're doing is you're building that picture of what your expense account should look like. What your accruals carried down and your prepayments carried down, or all this is these are the accruals and prepayments that relate to this financial year. What we're doing, and it's this bit, oops, do that, sorry guys. What we're doing here is trying to work out what is the charge that we need to put through to the income statement, and the vast majority of times this is what you are being examined on in your exam, which is what is the income statement charge. And what you have to do is you literally have to plot the figures in the relevant places. So buying this expense account is absolutely essential. And so, because time's ticking and I'm conscious I don't want to keep you, for more than we need to, I've got an example for you to have a go at on your own. So I'm going to give you a few minutes. I'm not going to read through it, okay? I'm going to let you read this, and then what I want you to do is I just effectively want you to tell me what you think the electricity charge is for the financial year. So I'm just going to give you a couple of moments, well, a couple of minutes. Okay, Kat so far has given an answer to 22,900. I'm not going to say whether it's correct or not, because I want you all to be working on this. Have a, that's all you can believe that if you do make a mistake, then you'll learn from it. So you'll literally know what's being paid, and I would suggest that you actually build up a T account, because that's how I'm going to show my answer. So just give you a couple more moments. If please don't, please do it through give the answer to me via the chat panel privately, so at least I'm getting an idea of how you're doing. Effectively, we might owe some money at the beginning of the year, probably means that we haven't paid for it, and therefore, we have to account for it last year, so, where does that belong on my little expense T account? We've got all those bank payments, and then we owe some money at the end of the year. Okay, I'll give you a couple more minutes. So everybody else been really quiet apart from Kat. Okay, I take silence as being possible we might be struggling. Let's work through this question. So, thank you, that's brilliant, that's fantastic, at least I know now. Let's have a look then. So it's saying on the 1st of January 2012, ABC Limited owed $4,000 in respect of the previous year's electricity. So what I'm saying is they still paid the bill, but using that accrual concept, they will have had to have accounted for that $4,000 in the previous year. That therefore means that that is an accrual brought down in the new financial year. Then makes the following payments during the financial year. So on the 28th of February it was 5,600, 14th of May it was 6,000, 9th of August 5,500, and on the 18th of November it was 6,200. Okay, so that's what they've paid in terms of electricity for the financial year. But year comes, you know, to do all your year-end adjustments, and they decide that actually we've still got 3,600 in for electricity for that financial year. So all I'm going to do is I'm just going to build that picture of what's going on so that I can work out exactly what the electricity charge is in the income statement. So I've done a nice lovely little P account, okay. What I'm going to do is build up my T account. So the first thing is that 4,000 that we owed in the previous year. Now we will have accounted for that. So in the previous year I've gone debit the electricity account and I've credited the accruals. Comes the new financial year, I need to reverse that out. So effectively I need to debit the accruals, which means, you know, I'm going to be on the 1st of January, back into electricity of 4,000. Okay. Then those 4 payments, you know, so we're going to be debiting the expense account and therefore crediting the bank. Not bothered about the bank, but all I'm going to do here, so on the 28th of February, payment of 5,600, and on the 14th of May, we've got a payment of 6,000. On the 9th of August, we've got the bank payment of 5,500, and then on the 18th of November, we have a bank payment of 6,200. But lo and behold, we're then told that you still owe 3,600 for the financial year. So I need to create an accrual to account for it in the relevant financial year, regardless of whether I've paid for it or not. So yeah, bounce again, we're bouncing back to that accruals concept. So on the 31st of December, I'm going to have my accrual, and I'm going to call this my accrual carried down of 3,600. What I need to do is effectively balance off the T account, and the balancing figure within my electricity T account is effectively what the electricity charge is. So what I'm going to do here is transfer to the income statement, and I'm really pleased to say that you are all correct that the balancing figure is 22,900. So done, everybody, that's fantastic. Now, just ask me a question. I'm going to credit the income statement. Effectively what you're doing is you're crediting the electricity account, which therefore means it's going to be a debit in the income statement, and all debits in the income statement is an expense, because obviously we need to offset it against the income, which is a credit in the income statement. Okay, so well done, absolutely everybody. I'm really, really excited that you've managed to get the 22,900, because, you know, it's with accruals brought down and carried down, sometimes students can get confused where it all belongs. So that little pro forma that I gave you on the previous slide, I think is the key to being able to answer these type of questions. Okay then, so moving on, I think I've exhausted the old accruals and expenditure accruals and prepayments. We just now need to revert this and have a look very quickly at income. Okay, we might have an accrued income, and we might also have an prepaid income. So what on earth do we do? Well, effectively, it's the opposite way around to that of expenditure. So let's look at the accrued income first. So, on the slide, it is income has been earned, but not yet been received. So, you know, let's say, for example, we've earned the money, but we've just not received it, either because we haven't raised the invoice, or, you know, the cash hasn't been received in for you lot in the exam. So we go to the accruals concept, where we need to match income and expenditure in the period it happens, and not when cash exchanges hands. So effectively, yeah, once again, we need to account for it, and with that, we've got the following journal entries. So we need to debit the accrued income in the financial position. We need to credit the income in the income statement, because if we think about it, we need to increase the income, the revenue, because we've earned it and we need to in this financial year, but we need to set up a debit, or we need to debit the accrued income in the financial position. And as it says at the bottom of my slide, The accrued income is a current asset in the financial position. So come on then, guys. Why is accrued income a current asset in the financial position? Okay, it's come up and it's correct. We are owed the money. Yeah, we are. It is effectively a trade receivables, but we can't call it trade receivables because we haven't made the invoice for whatever reason. So we keep it separately to say this is accrued income. This is money that we are owed. So effectively, yeah, it is money owed. It is trade receivables, but it isn't in essentially. So we do need to keep it separately. And we move on to the prepaid income, which is exactly the opposite to accrued income. Is that this is income which has been paid in advance but has not been earned. So someone's given us the money, but we haven't earned it as yet. Using that accrual concept, basically, we need to remove the income. So yeah, Catherine says it's the same as deferred income. Yes, it is. Okay, I call it prepaid income. You can call it deferred income. It's exactly the same. Okay, so we need to get it out of the income T account, and we need to put it somewhere. So yeah, it's going to go to the financial position. So all we're going to do here is we're going to debit the income. So effectively, we are reducing the income, the revenue, that's obviously going to go through the income statement. So amount, which effectively is reducing the profit. So we're going to set up a credit in the financial position, which is the prepaid income. And I'm saying, once again, the bottom, the prepaid income is a current liability in the financial position. So guys, why is it a current liability in the financial position? So why is it current liability? Okay, so money not earned but has been paid but could potentially be returned, says Lab. You're absolutely right. Yeah, we haven't earned money, so, I suppose it's reversing that insurance example earlier, is, we are their insurance company, our clients come back to us and say, look, we'll cancel our policy, we can get it out cheaper elsewhere. So effectively, we owe them that money. So yeah, it is liability because effectively we could owe them the money. Okay, so fantastic, well done everybody. So yeah, that is an example of, of prepaid income. So effectively, we need to reverse it out. Okay then, guys, exactly the same principle as before. If we've got an accrued income or a prepaid income, we do need to reverse it. Okay, if it's from the previous year. What is an example for you to have a look at and have a go at? It is quite technical. Okay, I will give you a little bit of a hint. So what we've got is that ABC owns 2 properties, which it rents to tenants, and in the year ending the 3rd of December 2012, it received $140,000 in respect of property A and $80,000 in respect of property B. Now the balances on the accounts are as follows. So what we've got here, we've got the 31st of December 2011, and we've got 2 balances. Okay, so that's your previous year, and then you've got some balances here, which is the current years. Okay, what we're asking ourselves here is what amount should be credited to the income statement for the year ending the 31st of December 2012 in respect of the rental income. And I'm going to give you a hint. This is saying what the balances on the rental accounts are. These figures here are your balances brought down. These balances here are not your carried down, but they're brought down for the new financial year. Okay, so I'm just going to give you a couple of minutes just to see if you can get answer. I will be working you through it. Don't you worry about it. Okay, so it's quite difficult. Okay, in terms of technically, and it's something I'd expect you to see within your ACCA and CIMA or your AAT exam. Then what will be the charge to the income statement, but we need to take into account first the brought down balances, so your previous year's, balances. And have a go. So you always credit your income accounts. Okay, so how we belong, honestly, guys. We're going to be finishing shortly. This is a question. So, don't worry. Oh, don't worry. It is a difficult question, but I just wanted to kind of show you the type of question that you could expect to see in your exam. Okay, given up. Don't worry. I'm going to go through it. Okay, let's talk through it. So this is a typical question I would expect to see in any exam. So what we've got here is that we've got obviously we've got some income and it's either accrued or prepaid. So effectively the keys are here is in terms of what it's telling us. So on the 31st of December 2011, property has a balance brought down on the credit side, and property B has a balance brought down on the debit side. Are we all happy with that? So it's telling exactly where balances lie within the T account. So if I just transfer my my page over to page, so all I'm going to do is I'm just going to deal with the brought down figures. So I've got brought down as per the question. So I've got 615 on the credit side, and I've got 1,700 on the debit side. So all I'm doing is literally putting the balances where it's telling me. Okay. So I've got some prepaid income and I've got some accrued income. Okay. That's what the question is telling me. Then it tells us that we received some cash during the year. So we received 140 for property A, we received 80,000 for property B. So all we do is record that. Remember, we're looking at income, so we're going to be crediting the income account and effectively debiting the bank. So all I'm going to do here is into my little T account. So obviously we've got bank of 1,000, and we've got bank again, which is the 80,000. The difficult bit is actually in the next part, which is the carry down. So in particular, what this is saying is these are the balances on the rental account. So effectively these are the balances brought down. So what we need to do here, oops, sorry, wrong page, is 1,700 is actually what on the debit side in the new financial year, and the 3,350 is once again it would be in the new financial year. So we just need to reverse this. So that 6,700 needs to go on the credit side, and that 3,350 needs to go on the debit side. That's all it means. So all I'm going to do is just post those journal entries. So I'm going to do so I've got the of 3,350 on the debit side, and then once again I've got the 6,700 on the credit side. So when I balance it all off, the charge that I'm going to get, what we're going to put through to the income statement is 226,800. Okay, typical. That is actually an exam standard question. Oh, sorry, it's me. I can't write this. I don't know where I've got those figures from. I'm doing creative accounting. So it's 140. Sorry, thank you very much, Catherine. And 80,000. Yeah, Okay, so 114.80, I do apologise. So, that is an exam standard question, regardless of whether you're doing ACCA or C. That's the type of thing I'd expect. So you need to get your heads round the brought downs and the carried downs, okay? So in this particular question, the carried downs needed to be the opposite way, because what they were saying is it was the, and I know it's very, very difficult, but must read the question carefully. Okay, so that's kind of it for tonight. What I just want to do is just quickly go back to my PowerPoint slide. So just want to say, this is what we've covered. We've covered the accruals concept, matching income and expenditure in the period happens and not when cash exchanges hands. We've looked at, accrued and prepaid expenditure, and we've also looked at accrued and prepaid income. The most important thing is remembering the drawdowns and the carry downs in terms of those accruals and prepayments. One thing I want to also add at the end is just make aware of our Kaplan Financial Knowledge Bank, and this is free to everybody. I've put the website address up there, and basically it's kind of a database of trying to think of just a database of information. So if you're struggling, I've been on the screen, a dividend. I want an explanation what a dividend is. Go into your Kaplan Financial Knowledge Bank. Will give you an explanation. So Catherine's just asking if I can just go back. Yep, I will do this in a second. So this is an exceptionally fantastic resource, the Knowledge Bank. So if you've got anything you're unsure of, whether it's accruals and prepayments or bad and doubtful debts, or it could be to do with dividends or ratios or variances, anything, then this is a good source. It's like I call it, we've got a dictionary for English. This is the dictionary for accountancy. And as Claire's saying, it is totally free. Anybody, as long as you've got access to the internet, can have access to the KF Knowledge Bank, and it's a fantastic resource, and it can help you significantly. Right, that's it for me for this evening. I hope you enjoyed the masterclass. Accruals and prepayments, don't get bogged down with the brought downs and the carry downs, but just learn those pro formas of where they all belong, because ultimately your exam question will be asking you, what is the charge to the income statement? Okay. I'm going to go back to the question, because Catherine's obviously asking me because you didn't catch quite the working. So for everyone else, good night. I hope you've enjoyed the session. If you've got any questions, I'll stay online for the next 5 minutes. Please fire away and ask me those questions. Okay, so good night, and thank you very much. Thank you. Thank you for all kind words. Thank you. What you wanted. Sorry, Catherine. Don't worry, I fully understand. Okay, so are you happy with that figure now and everything? So the brought down and carry downs are the most important bits, and it's making sure you get them on the right way around. So it's difficult, and it depends on how you determine and how you interpret the question as well. Adding or deducting, so for example, once you've established where the carry downs go, you just put them on the relevant side. So once you know where those carry downs are, if it goes on the debit side, then you just adding it up as if it's a normal T account. Ultimately, because what you've learned in your previous studies is that you're trying to work out what your carry down what your carry down figure is within the T account. All that's happening here is actually you've been given the carry down figures, so it's kind of like the incomplete record approach is, well, actually, what is the income statement charge? Well, the income statement charge is whatever that balancing figure is. wouldn't say you're adding or deducting. It's once you've established where that carry down belongs on the debit side or the credit side, then effectively what you're being asked for to calculate is that balancing figure. Okay, fantastic. More questions to ask me? Call it a night. Okay, has anybody got any last minutes before I call it a night? Then, thank you very much, everybody. I'm going to log off now. So all I can say is good luck in the rest of your studies. So good night.